Have you ever been there? You you bought an option, maybe a call. You were super confident the stock was going up.
Yeah.
And then it did. The stock did exactly what you thought, but your option, it lost money.
Oh, yeah.
It feels completely wrong. Like the market just pulled a fast one on you.
It's incredibly frustrating. We hear about it all the time, especially from newer traders.
It really does feel counterintuitive.
Absolutely. Because you got the main thing right, the stock's direction, but you still ended up losing.
Yeah.
And, well, this situation, the one that trips up so many people, it usually comes down to this thing called IV crush.
IV crush, okay.
It's a really fundamental concept in options, but yeah, it can be a painful lesson if you're not ready for it.
And understanding it isn't just about avoiding the pain, right? It's maybe about finding an edge. We, at AdvancedAutoTrades.com, we really believe that trading smarter means getting these mechanics down. And looking at the notes and research you sent over, it's clear you've been digging into this. So let's get into it. Let's really talk about IV crush today. What is it? Why does it happen? How does it, burn traders?
Right.
And maybe most importantly, how can you actually trade with it instead of, getting crushed?
Okay, yeah, let's break it down.
Oh.
IV crush. So it stands for implied volatility crush.
Implied volatility crush. Got it.
And what we're talking about here is basically a sudden, pretty sharp drop in an option's implied volatility.
Right. And implied volatility, IVQ, that's kind of the market's best guess, right? It's forecast of how much a stock might move.
Exactly. It's the market's expectation of future movement, not a guarantee, but it's like the collective.
Yeah.
Maybe the collective anxiety priced into the option.
Anxiety, yeah, I like that.
So IV represents the uncertainty baked into the option price. Now think about big scheduled events, stuff like quarterly earnings, a Fed interest rate decision, inflation reports, jobs numbers, maybe a big product launch.
Okay. Stuff everyone knows is coming.
Right. And leading up to those events, there's a lot of uncertainty, isn't there? Will earnings be good or bad? What's the Fed going to do?
And that anticipation, the not knowing, it pumps up the implied volatility.
Right.
Because traders expect a potentially big move.
That's exactly it. They price in that potential for a big swing either way. So both calls and puts get more expensive.
Yeah.
The market's bracing itself.
Higher premiums across the board.
Precisely. People are willing to pay more because the chance of a big, fast move seems higher. But then, the moment the event happens, the news is out. The uncertainty that was driving everything up, poof, it vanishes. The market knows the score now.
So the reason for the high price disappears?
Exactly. And that extra premium, the part that was baked in just because of the anticipation, it collapses fast. That rapid collapse in implied volatility is the IV crash.
Okay, I think I'm getting it. So like you said, maybe like an inflated balloon. The pressure builds before the event. That's the high day. Then the event happens, the news hits, and pop.
Pop goes the volatility.
The pressure's gone, 4V collapses, and the options value deflates. Even if the stock moved the way you wanted.
That's the kicker.
That balloon deflating right when you thought you needed it, that's the crush. Wow.
It's a good analogy.
Yeah.
And that sudden deflation is exactly why it feels like you're being punished for being right on the direction. You paid for high volatility.
And then it just wasn't there anymore.
It disappeared, taking a chunk of your option's value with it.
Okay, so based on what we see, the patterns, the examples you shared, when does this IV crush usually hit the hardest? Is it predictable?
Oh, very much so. It almost always strikes immediately after those scheduled events. Earnings calls finish, the Fed statement drops, CPI numbers are released, boom.
Any known event with a potentially big outcome?
Pretty much. If there's a date on the calendar where big news could drop, you can expect IV to climb beforehand and then crash right after.
And just to nail it down, the why, again, is because the uncertainty that pumped up the IV is suddenly gone.
Yeah.
Resolved.
Yes. Before the event, the market's pricing in a whole range of possibilities. Some pretty wild ones, maybe.
Yeah.
That potential range adds value.
Right.
Once the outcome is known, that range narrows instantly. The market recalibrates. The odds of those extreme moves you were paying for plummet. And the option price reflects that immediately.
And this hits option buyers way harder, doesn't it? Especially if you buy right before the event when IV is peaking.
Absolutely. You buy that call or put when IV is sky high, you're paying top dollar for that expected jumpiness. When the event passes, IV tanks, and boom, that volatility premium evaporates from your options price. You lose value just because the market's expectation of future movement dropped.
It's like buying really expensive insurance for a hurricane that ends up being just a bit of rain.
That's a great way to put it. The storm passes, the risk is gone,
Mm-hmm.
and your policy is suddenly worth way less.
Okay, let's try a specific example. Something maybe from the data you shared or just a common scenario. Say someone buys calls on Apple, AAPL, right before earnings.
Okay, classic case.
Everyone knows Apple earnings can move the stock, so IV is high, premiums are up. This trader thinks Apple's going to beat. It's going up.
Yep.
Earnings come out. And Apple does go up, let's say 3%. They were right.
Yeah. But their call option loses value. Or maybe it barely breaks even after commissions.
How? Why? They called the direction.
Because the market, through that high IV, had probably priced in an even bigger move. Maybe it expected 5% or more.
So the actual move wasn't surprising enough relative to the expectation.
Exactly. While Apple went up, it wasn't the huge jump the options market was braced for.
Yeah.
So the uncertainty value, the high IV part of the premium, it collapsed because the earnings news resolved everything. That premium vanished.
So the gain from the stock going up 3% just wasn't enough to cover the loss from the IV collapsing.
Often, yes. That's where Vega comes in the option premiums. Greek measuring sensitivity to ID changes. When an IV drops hard, Vega shows you how much value gets ripped out of the option premium. It can be substantial.
Okay, so the real enemy isn't getting the direction wrong sometimes. It's overpaying for expected volatility that just evaporates when the news hits.
That's the core of it.
And we see this a lot, right? Like in the examples from your materials. With those big tech names, TSLA, AMZN, NVDA, they often have huge IV run-ups into events.
Definitely. Those stocks are actively traded, options are popular, and big events just amplify that volatility component. Classic buy crush setups happen there all the time.
So, okay, for someone just starting out, the simplest way to not get, well, crushed by IV crushes, just avoid buying options right before these big known events.
That's certainly the most straightforward defensive approach. Avoid buying naked calls or puts when IV is super high, unless you have incredible conviction and you really understand how much premium you're paying just for that volatility.
That's defense. But you mentioned opportunity. The way we often think about it at advancedautotrades.com, it's not just dodging the hit, right? It's maybe using that high IV.
Exactly. Shifting perspective. Instead of buying when options are expensive, consider selling when they're expensive.
Selling premium. Okay, now we're talking strategy.
This is where it gets interesting. While lots of retail traders might be buying those inflated options, more experienced folks are often looking to be the ones selling that overpriced premium.
Right. Taking the other side of that bet?
And certain strategies are specifically built to profit from volatility going down. The iron condor is a really good example, and it's one we find works well in these high IV pre-event situations.
An iron condor?
Yeah.
Okay, explain that. It benefits from vola falling and the price staying in a range.
That's the idea. It's a neutral strategy. You sell a call spread above the current stock price, and you sell a put spread below the current stock price. Same stock, same expiration date.
Okay, selling two spreads.
And here's the key. When implied volatility is high, like before earnings, the money you collect the premium for selling those spreads is much higher than usual.
Because everything's inflated by the high IV. Makes sense.
Exactly. Both the call side and the put side fetch more premium. Then the event happens. The news is out. 5E collapses the crush.
And the value of the spreads you sold goes down.
Precisely. It drops fast. As the seller, that's good for you. You collected a big premium up front, and now the value of what you sold is shrinking, partly because that volatility component just vanished.
So the IV crush actually helps the iron condor seller. It's like a built-in advantage.
It becomes a tailwind. You're basically betting that the stock won't make a crazy move outside the range you defined with your strikes, and that the overpriced volatility will come back down to earth, which it almost always does after the event.
And you set the strikes outside the expected move to improve your odds.
That's the standard approach. You look at what the market is pricing in as the expected move, and you place your short strikes further out than that. You collect premium for taking on risk the market itself thinks is less likely, plus you get paid for volatility that's almost guaranteed to drop. And you get time decay, theta, working for you too.
Okay, that makes sense. But to play this game effectively, whether you're avoiding the crush or trying to profit with something like an iron condor, you have to know when IV is actually high, right? How do we measure that?
Good question. We rely heavily on a couple of key metrics, 5E rank and 4 percentile.
5E rank and 4 percentile, okay.
5E rank basically tells you where the current IV level is compared to its range over the last year, usually. So a 75% IV rank means current IV is like 3/4 of the way between its 52-week low and its 52-week high. It's high relative to its own history.
Okay, relative to its own past range. And IV percentile, how's that different?
IV percentile tells you what percentage of the time in the past year 5E has been lower than it is right now. So an IV percentile of 80% means that 80% of the days in the last year, IV was lower than today's level. It also signals that volatility is relatively high historically.
Gotcha. So when we're looking for setups like for selling premium around events, we're often scanning for IV rank maybe above 50% and IV percentile maybe above 60% or even higher.
Yeah, those are common thresholds we use at advancedautotrades.com. It tells us the options might be pretty rich, inflated with volatility premium, making it potentially a good time to sell defined risk strategies like condors.
What about tools? How do you track this stuff easily? The research mentioned a few platforms.
Yeah, lots of good platforms show this now. Thinkorswim has great charting for 5E. Tastyworks is really built around vol trading, makes IV rank and expected moves super clear. And Market Chameleon is fantastic for digging into earnings-specific IV data, seeing historical crushes and expected moves. Using these tools is pretty essential to spot the opportunities.
Okay, let's walk through that Fed example you mentioned again, maybe make it more concrete. Say it's the week of a Fed rate decision, market's on edge.
Yep, typical scenario.
SPX implied volatility is high, maybe IV rank is 75%, IV percentile is 80%. Options are expensive.
Right. Everyone's braced for Paul to say something market moving. Premiums are fat.
Then the announcement hits. It's exactly what everyone expected. No surprises. The market, SPX, barely moves. It just kind of sits there.
What happens instantly?
IV collapses.
Right. The uncertainty premium evaporates because the news is out and it wasn't disruptive. The IV crush is immediate and significant.
So the trader who bought, say, a straddle on SPX, betting on a big move either way,
They likely lose money. Even though the market didn't really move against them directionally, the value of their straddle plummets because that huge IV premium they paid just vanished into thin air.
ouch. Okay, but what about the other side? The trader who sold an iron condor on SPX before the announcement placed their strikes outside the expected move.
They're likely looking at a quick profit. The IV crash works for them. The value of the spreads they sold drops rapidly. Add in a bit of time decay. They can often close the position for a gain relatively soon after the announcement.
That really highlights how IV crush can be the engine for that kind of strategy.
It absolutely can. It turns the source of pain for buyers into the source of potential profit for sellers.
And this whole approach, finding high IV, using defined risk like iron condors, letting the volatility collapse work for you, that's really central to how we approach trading these events at advancedautotrades.com, isn't it?
It really is. It's about understanding the mechanics and using them strategically, turning a common pitfall into a potential advantage.
Okay, so let's just quickly recap the main takeaways here based on what you shared in our discussion. First, IV crush, one more time. What is it?
It's that rapid drop in an option's implied volatility, usually right after a known event, making options cheaper.
And it happens most often.
Right after things like earnings, Fed meetings, key economic data releases, scheduled catalysts.
Well, FX calls inputs.
Both. 4 is part of the price for both, so when it falls, both lose that vol premium.
Best way for beginners to avoid getting hurt.
Simplest way. Be super careful buying options right before those big events. Or if you do trade, use defined risk spreads.
And a strategy we talked about to potentially profit from it.
Selling premium when IV is high, using strategies like iron condors, is often effective. You collect that inflated premium and benefit when the IV inevitably drops.
So if you've ever felt that frustration, that sting of being right on the stock but losing on the option, you've probably met IV crush.
Yeah, you've experienced it firsthand. And it's not some market glitch, right? It's just how options pricing reflects expected volatility.
When that expectation is super high before news, prices are inflated. News hits, expectation resets, inflation disappears instantly.
For a lot of traders, it stays a mystery, a source of unexpected losses. But like we see in the analysis and in practice, getting IV crush turns it completely around.
Yeah, it goes from being a cost or a surprise hit to being a potential strategic edge. Changes how you look at volatility entirely.
It really does. And it makes you think, what other events out there, maybe less obvious ones, create these high IV setups? Finding those, analyzing the potential crush, structuring trades. That's where the ongoing opportunity lies.